All right, hello everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our options trade of the week. We have seen the markets really pick up over the last few weeks. In fact, volatility has exploded to the upside for really the first time all year. We had the VIX up well into the 20s here earlier this week. We've had big range in the market, we've had good volume, and I've had a lot of questions come in from people asking how do we adapt to this new environment that we're dealing with. I've been talking about it over the last few videos. I expect the good back and forth movement to stick around through the rest of this year. I think there's going to be uncertainty there that the market's going to price in. The problem with just strictly buying long calls and long puts in this market, the missing piece has been the follow through. We've had a lot of big back and forth movement, but it's only been intraday. We haven't seen that follow through into day 2, 3, and 4. If you buy a call option here on Netflix, for example, expecting this market to move higher, it has to move higher in a decent way over a stretch of a couple of days. A couple of hours here to the upside is not going to do enough for us to hit a profit goal. Well, with the movement back and forth and all of the uncertainty that's now being priced in, I'm not as confident in a big move happening to the upside. While the market is oversold in the near term, anytime that we've tried to rally all week, a headline hits and the market sells off. And vice versa. When the market looks like it's ready to break lower, a headline hits or a Trump tweet hits and the market rallies right back to the upside. Well, instead of just trying to force feed long calls and long puts to work in this environment, we want to have a bigger toolbox that we can go to. We want to have a bigger range of strategies that'll fit different types of market conditions. If I'm going to buy a call again here on Netflix, if I buy a call, that thing better move to the upside. The stock better move higher pretty quickly. Well, what else can I do to be bullish, but with more of a neutral kicker in there, just in case the market just kind of chops sideways? What if we just kind of bounce around in here for another few weeks? Well, if I sell a put spread here, if I use a credit spread, it still allows me to lean bullish, but it gives me that neutral kicker that I'm looking for. Just in case we kind of chop sideways or maybe we even drift to the downside a little bit further, that's a strategy that can be really well used in this type of a market. The volatility being elevated, in this case, the VIX right now at the time of this video is at 18.5. It got up into the low 20s here earlier this week. It's a reading that we don't typically see all that often. And when it does happen, it doesn't tend to stay at those elevated levels for long. That is the market's way of pricing in the uncertainty. And when that happens, the options get more expensive. One way to take advantage of that is if I sell an option, I can collect more up front. That gives me more profit potential and potentially a better risk reward scenario. And it gives me another way of making money, because if the volatility contracts like we expect it to do over the next few weeks, that's going to cause the options to get cheaper, and that helps with a credit spread. Now, why do I want to be neutral to bullish here on Netflix? What piques my interest towards that type of a trade? Well, notice what happened just over the past few days on our pulse indicator, and that's the red, yellow, and green histogram down here towards the bottom of my chart. We have had a whole slew of yellow bars over the past few weeks, and those yellow bars will print when we're between a 1 and a 2 standard deviation channel move on the downside. We then got 2 green bars here just the last few days. That indicates price action is now between a 2 and a 3 standard deviation channel move on the downside. What does that mean? When you start to see a 2, a 3 standard deviation move, it means that move is getting tired. It doesn't mean we can't continue to see a trending move to the downside. It could happen. It's just not probable. When you start to hit a 2, a 3 standard deviation move, in this case on the downside, the chances of this thing continuing to move to the downside in a big way, a few percent or less. So when you start to look at this, chances are price action is going to most likely either consolidate or try to bounce to the upside here. We're just kind of at that level where we typically see that type of action. If I want to lean a little bit bullish here, neutral to bullish, I can start to back it up through statistics, because again, I know odds favor either a period of consolidation or a move to the upside, strictly based off of what the pulse indicator is telling me down here. So if I take that and go over to the trade page, when this type of a market, because it's so active and the range is good, the volatility is good, I do think it opens up some potential for the weekly options again. I like to use the weekly options more so with credit spreads rather than buying options. If I'm going to buy a weekly option, it's a pretty aggressive play. You need a lot to work out in your favor in order for that trade to work. Using a credit spread on a weekly option, it flips everything around in my favor. Now the time decay increasing helps me. The volatility movement helps me. The gamma tells us how quickly the options are going to react to changes in stock price. That helps me. So now I start to stack the deck in my favor. Well, what I decided to do for this week's trade is to go out into the September 6 weekly options. Those are the ones with 21 days left to expiration. I want to sell a put spread on this trade. So I'm going to go to the out of the money puts, and I went to the 290 put strike. I'm going to right click on that option. I'm going to go to sell, and I am going to select a vertical. And it pops up an order down at the bottom where I am selling the 290 put and I'm buying the 287.5 put at the same time. Following our criteria, we typically want to collect between 30 and 40% of the width of the strikes. So in this case, I want to collect between 75 cents and $1. I can't do it here. We're a little bit light. I can only collect right around 70 cents. It's close. It's within 5 cents, but it's not close enough. I want to collect between 75 cents and $1 because in doing so, it's going to give me a good risk to reward scenario. So in order to collect more money, what I'm going to have to do is to adjust these strikes and move them closer to the current stock price, which is just above 301. So what if I click on these strikes? I'm going to change the 290 to 292.5, and I'm going to switch the 287.5 to 290. Now I can collect 77 cents. I know it doesn't seem like a big deal. It's an extra 7 cents, but it does make a big deal because number one, it allows me to stay more disciplined to my set of mechanics. It allows me to focus on a strict rule set. And if I collect 77 cents, you'll notice here, I'm risking $173 to make 77. I'm right between risk 2 and 3 to make 1. That's the range that I want to be in. I don't want to risk 3, 4, or 5 to make 1 because I can't make the numbers work long term. Some of you might be looking at this saying, how can you make the numbers work at all? Why are you risking more to make less? The reason why we're willing to accept that is we have such a high winning percentage on these trades. Here's why. We have 5 ways of making money on the trade. My break-even point would be at 291.73. You can see it in the order confirmation box. I don't care if Netflix moves up, down, or sideways. As long as it stays above 291.73, I get to make money. So I can be dead wrong by $10. This is a neutral to bullish trade, remember. But I can have this thing move against me to the downside by $10 and I'm still okay. The only move that hurts me directionally is a big move below 291.73. Well, we already talked about price action being between a 2 and a 3 standard deviation channel move on the downside. We're already extremely oversold. The odds of another big move to the downside, pretty slim. So now I'm starting to stack the deck in my favor directionally, but then I also make money from time decay adding up. So every day that passes, I make money from that time decay, and I make money if volatility decreases. We know the volatility market-wide is elevated, and we also know historically when it gets elevated, it tends to stay that way for a couple days on out to a couple weeks. Well, we're now a couple weeks into that higher volatility, so chances are going forward that volatility is most likely going to start contracting. That would also help this credit spread. So I give myself 5 ways of making money on the trade. The price moves up, down, or sideways as long as it stays above 291.73. I make money from time decay and from volatility decreasing. So there's my 5 ways of making money on the position. Now, how would I manage this trade? What is my target level? The only way that I can keep the $77, that's what I'm collecting to put the trade on. The only way that I can keep that entire $77 is if I hold right up to expiration. That's not something I want to do because in holding to expiration, the gamma starts to increase. And in other words, that means the options become more sensitive to changes in stock price the closer we get to expiration. And what can potentially happen there is I could be profitable for the first 14 or 15 days of this trade, and then in the last few days, I could have a reversal happen and I could give back all that profit and go into a loss. I don't want to let that happen. So what I typically do, my goal is to close out of this trade before expiration week. And my target zone is when I can close this trade out and keep between 50 and 75% of my max profit. Remember, the $77 that I collected to put the trade on is my max profit. If I can buy this thing back for between 19 and 38 cents, anywhere inside of that range, that would be acceptable. I like to start my closing orders at the 75% level. So if I can create that closing order to buy the spread back for 19 cents, that would be acceptable for me. That's what I'm looking for initially. So if I put this trade on today, I can create my closing order here today as well to buy the spread back for 19 cents. I would just set that closing order to a GTC or a good till cancel order, and that way over the next few weeks, that order's working. I don't have to be by the computer staring at the charts all day long. I just let the trade work. All right, so we'll continue to track this one here over the next couple weeks, see what happens, see how we want to manage it from start to finish, and I'll keep you guys posted there. Before I wrap up the video, let's just take a quick peek at some of our existing positions that we had on that we've put on here in previous videos. The first one was on Pinterest, and we were taking a look at selling the 37.40 call spread. So let me go ahead and pull up this trade. And this was in the September monthly option. So let me go ahead and load those up here. So we wanted to sell the 37 call and buy the 40 call at the same time to make it a risk-defined trade. We put this position on initially for 80 cents. It's now trading for 35 cents mid-price. Well, anytime that I sell a credit spread, my target is 50 to 75%, right, of whatever I collected to put the trade on. So if I collected 80 cents there, my target zone is between 20 and 40 cents. We are now approaching that level. In fact, we're in that 50% range. You could close this thing out now if you wanted to. I'm actually going to keep it on a little bit longer. Okay, I'm going to hold it. I'm going to still try to hit that 20 cent number to get our 75% of max profit. But if you feel uncertain about that, if you don't want to hold, I have no problem with you closing out of the position now and taking the partial profit. But I'm going to hold it into next week. I'll recap it again next week in our video to let you guys know. If you have any questions between now and then, feel free to send me an email, mike@netpicks.com. Our trade from last week was actually an iron condor on DIA. This is the Dow ETF. So an iron condor is a neutral trade where we're trying to create a profit window. And it's put on by selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. And if you missed last week's video, I highly encourage you to go back and review it. And we'll cover it in more detail on why we placed it, what does it do for us. But essentially, we sold a 268 called and 250 put. And those prices define my profit window. I want price action to stay inside of those levels. Price action is currently sitting at 258.50. Have we seen big moves back and forth this week? You bet we have. But that's okay because we still stayed inside of our short strikes. So now I'm making money as time decay adds up. If volatility decreases, that's going to help me. We sold this trade for $1.08 last week, so $108 per spread. It's now trading for 94 cents. We're up about 14 cents or $14 per spread. We're still targeting 50 to 75% of whatever I collected to put the trade on. So my target zone is more down in that 25 cent number. So we're still going to hold it. We're not going to close it out yet. Again, I'll recap it again next week for you, let you know what we're doing. But so far, so good on the two existing trades on Pinterest and DIA. We'll continue to hold them. We're in some nice profit on both of those. So if you have any questions on the older trades or anything on the new trade on Netflix for this week, feel free to post a comment here in the YouTube video or on the blog post, or you can even email me directly. Mike@netpicks.com is the email address. So I'm going to wrap this video up here. Enjoy your weekend, everybody, and I'll be back with you guys next week for our next trade of the week.